Hi, Dominique, and welcome to another edition of the week ahead.
Hi, Andrew.
Hope you're doing well, and happy that we're able to get this going. So, as we always like to do, let's kind of start from a recap of the past week. So, obviously, the data that came out, any comments we got from the Fed, and obviously the market reaction. So, this week was an exciting week, as most of the weeks this year always seem to be, but also fairly surprising. But obviously a lot of information this past week, so let's kind of unpack it. So I'll let you kind of take it away.
Okay, so let's start with the Fed. We got another attempt by Chair Powell to communicate to the market that the hikes were going to slow, likely in December, but at the same time, the terminal rate was going to go up in the December SCP, and there was a risk it could go up for some more if inflation did not slow. And as usual, the market was happy to price in the first part of the message and completely disregarded the second part. So financial condition eased a bit more. And if you look at the Goldman Sachs index of financial conditions, it's now below where it was when the Fed funds was 150 basis points lower. The market did get its comeuppance, however, with the NFP, which I was very happy about because, my views are so different from consensus that I sometimes wonder if I live in alternate reality, but NFP was actually just as I expected, a large headline surprise. And finally, the pickup in wage growth, which I had been expecting. I published on this. I mean, if you do a super, super simple chart, which you can even do on Bloomberg, of unemployment against real wage growth. Real wage growth is negative, it's falling, and it's totally out of whack with where unemployment is. So I was expecting a catch-up, but as always, the data is volatile. You can't be sure what will happen. So I was quite pleased with the NFP, but obviously the market was not.
Yeah, definitely. Were you surprised by Powell's comments, or you think you were more surprised that the market kind of picked out the part that they liked and ignored mainly his core theme, which has been fairly consistent?
No, the market has been very consistent in ignoring the part of the message it didn't like. Yeah. But I was kind of delighted with Powell's message because, so first of all, I think he's really coming into his own as a head of the Fed. His first Jackson Hole seminar, when he was just appointed, he actually thanked the organizers of the seminar for inviting him. And, that gave a sense that he was perhaps awed by, this aura of perfect knowledge of the 400 PhD economists and this sort of a technocratic elite. And he got caught because he just conveyed to the public the Fed view of inflation that was wrong. This thing about temporary, it's not his invention. Chair Yellen, or ex-Chair Yellen, in a 2015 speech said that when inflation comes from the supply side, as long as expectations are anchored, it's self-correcting. And poor Chair Powell got caught holding the intellectual bag, so to speak. And what I liked about this speech is that he's starting to have his own view of the inflation process. He's obviously not trusting his staff anymore. I mean, he got burned. It's hardly surprising. And his point was that instead of, making a numerical forecast, he would describe the macro scenario that would be needed to see a decline in inflation, and therefore that would drive his policy making. And what delighted me is that this is a framework I've had basically since the spring.
Yeah,
So,
I mean, but exactly what he said, which is the real thing that is kind of in their control, or that they're really monitoring as well, it is the wages. And yet on Friday, people can say it's a strong number, but it was like, unless it was different underneath, like it's within the range, but wages were much higher, absolutely different, which is exactly what his concern was and your concern. But yet the market kind of saw through that. And I'm not, listen, there's definitely something to say that we're getting towards the end of the year. A lot of certainly like trading desks, macro multi-strategy hedge funds maybe had decent years, good years, and looking to cut down risk. You saw the news about your old colleagues at Bridgewater that, were super bearish, I guess, on stocks and bonds and credit, and they're getting hurt on that. I just don't know if this is, so were you then very surprised by, it's like initially the market's like, oh, this was like a horrible number because it was fairly strong on payrolls, but much higher on wages. Like that's like the worst case scenario. Absolutely. The best case scenario would be like slightly weak on payrolls and very soft on wages. And this was the opposite, So why do you think, forget about the equity market, but like, why do you think that bonds ended up rallying eventually off that? There may be other data that was come out. There's like soft data. There was questions about the different employment assessment, indicators that people use and stuff. So do you have an idea? Or do you think it's just the market is in this narrative? And
I think the market is in this narrative, and frankly, they are not the only one. I mean, in my view, the doves on the FOMC are kind of living in an alternate reality, certainly not mine. Yeah. And I think what's going to bring everybody on the same page is continued strong growth, wages, and inflation prints. I mean, the Cleveland Fed inflation nowcast still shows CPI for November, so that we are going to get a day before the FOMC at 51 basis points, So
yeah. And the people who are saying, well, yeah, that I understand all that, but like something's happened, I think more in the US, even in Europe, in the last like month, there seems to be this prevailing view, like growth is falling off a cliff or very weak. Are you seeing any of that?
So
do you agree that that's a little bit of the theory that's, Sure. And this is maybe even backward looking at.
So they have a little bit of a point there, because if you look at the Cleveland Fed, not the Cleveland Fed, the Atlanta Fed GDP nowcast, which is a nice aggregator of data on the demand side, it shows a decline of 1.4% to 2.8%. Largely driven by consumption numbers. But it's a little bit difficult to interpret because we got personal income and personal consumption, but there was a heavy revision of the data. So we got a bit of a different time profile. In terms of what I was looking for, which was a significant pickup in year-on-year growth of real household income, excluding government transfer, it didn't happen. It didn't collapse, but we're still in this sort of trough. So intermediate period where things are going to either move up or move down. I'd argue that with the sort of employment growth we are seeing, and with household savings rate remaining very low, it's more likely to go up than down. But as always, I stand to be proven wrong by the data.
If the savings rate really low, there's a point that consumers will run out. So right now we view a low savings rate as meaning the economy is strong because people feel fairly comfortable that they're going to continue to earn more. But is there a view that turns negative quickly?
So first of all, the savings rate is still positive, which means people are not actually dipping in their wealth. They are spending more of their income. And then I would argue that given the growth rate of employment and wages that we are seeing, it's okay to have a stable savings rate, because income growth is going to pick up.
Yeah, I mean, listen, it was a surprising week. Surprising how the market took Powell's comments or presentation, I guess. We had one of our partners that was there, was kind of texting us during the event. And obviously the market's reaction to payrolls. To move ahead for this coming week, and I know kind of like the really big week is the following week, but this week, anything investors should really be looking out for on the data? It actually does look like a decent amount of stuff coming out, but on the data or Fed speakers that people should look out for?
So the Fed speakers, it's a pre-meeting blackout, so we get a bit of respite on that front. In the data, we get a few things which are not as important as CPI and NFP, but still fairly important. So we get the PPI, and as always, I'm looking for a turn in the price of semiconductors, which frankly is as important to modern society as energy or oil, for instance. Yeah. And that turnaround is not happening.
You mean prices are not coming? I see like some semiconductor companies are struggling.
Yeah. Well, that really is a paradox. And I think it suggests that there is a bit of a disconnect between supply and demand. That my understanding is that it's more of the traditional chips that are lacking, and that the foundries are more invested in a state-of-the-art chips, and that could explain why the chips price index contained in the PPI is still rising. Right. Because you're right, there is a disconnect with a chip manufacturer and chip prices. But in terms of cost pressures on the US economy, it's very simple. Since the pandemic, it's only gone one way, and that's up. So I'm looking for things to change there. Then we had the the PMI, the services PMI. And last week, the services manufacturing was really bad.
You're saying there's S&P and I see ISM. And I know I've asked you this before. What's the difference? And I'm guessing, like a lot of things, there was very little difference pre-pandemic, but now, because I guess the underlying companies or jobs that they analyze are slightly different. That's why the
S&P has a broader sample, small, medium, and large companies, while the ISM has really mainly large companies. The problem with the S&P is that they don't release all of their data. They only give you 2 years and so on and so forth. So it's really difficult to make sense of it. So last week, we had a pretty poor manufacturing survey. And indeed, in the data, in the NFP data on Friday, there was a bit of not a contraction or flatlining of manufacturing employment, which actually had been growing very strong through the pandemic. So the services PMI is quite important. Consensus,
and that's a pretty low number, right?
Yeah. Well, I mean, the US
anything under 50 is low, I guess.
Anything under, because it's a diffusion index, so it's a difference between the firms that report an increase and the firms that report a decrease. Anything under 50 implies that there are more firms reporting a decrease in whatever aspect of the surveys than an increase.
Yeah.
But the PMIs have decoupled from economic activities. They had started to decouple before the pandemic, and even more so after. That's a piece of data is a piece of data. Certainly, if we have underperformance of the services PMI or a contraction, it's a really important piece.
It was the Chicago. Was it Chicago PMI? What was the one that was like really weak?
The S&P manufacturing.
Okay.
Then we have consumer confidence. The market expects a sideways move, which would make sense given the strength of the labor market, and also the fact that recently headline inflation has moved sideways. Gas prices at the pump have consolidated, and that's the things that Americans notice the most, right? Because you have to go to a special place to fill your tank, and you can really see the difference. Not like you are buying 50 types of cereal for your breakfast, and it's more difficult to track.
You can really pick out, like no one remembers exactly what they paid for butter a year ago. But people are like, oh, now it's $5.50 a gallon, and it used to be $3.50 in a gallon. So like it's a lot higher. Yeah.
Exactly. So with gas prices down a bit, it makes sense for the UMich survey to move sideways, or even perhaps surprise on the positive side. But the most important aspect of next week is politics. I mean, we have the Georgia runoff on Tuesday, and this is actually quite important because even though the Democrats right now have the majority in the Senate, because it's a 50-50, and what gives them the majority is the vice president is a Democrat. Because it's 50-50, they have to split the membership of the committees into. So in terms of controlling the legislative agenda, it's not that easy because they have to agree, since it's the same number of Democrats and Republicans in each committee. But if they win the Georgia runoff, and the betting sides gives them 70% odds of doing that, then they will have the majority in the committees and greater control over the Senate agenda. So it's not it's not a trivial matter. And what I suspect is going to happen is that we'll have a much better idea of the legislative proposal, of the legislative agenda of the lame duck, so of the session of Congress until the end of the year, where the Democrats still have majority in both chambers. And one of the big question mark for me is whether they will do a debt ceiling increase. If not, or maybe they've become so blasé that, and it's true, this debt ceiling business is really like a ritual with a lot of chest thumpings by alpha males. I mean, I'm sorry, but I can't think of a better way to describe it. Maybe they think that it's becoming a non-event. We'll see, but fiscal policy, so possibly a new budget. But even if it's a new budget, we're not going to see big initiatives. Government funding expires on December 16. I'm actually not sure Congress will be able to get a budget before then, so we are likely to get a continuing resolution. But still, the result of the Georgia runoff will be very, very important, even for the.
Will the markets react either way? Is it like the markets would be negative if the Democrats won because they
not necessarily
maybe more spending, or it's probably not a big market moving?
Well, so Democrats may be able to impose more regulation. So I would think if there is a reaction to a Democratic win, it would be a negative one, probably.
Yeah.
In the short term, but in the long run, a better control of the Senate on the margin could make it easier for the Democrat to, to, who knows, spend more, impose new regulations. One big issue is Senator Manchin's permitting reform. In the US, it's very hard to build anything new in terms of energy because it's such a complicated legal environment. You need to get authorization from 3 or 4 levels of government. Then very often you are on people's private property, so you need to invoke eminent domain. And Manchin's bill was to simplify all this. And so it could get passed in the lame duck. Let's see, that could make a big difference.
But wouldn't the Republicans be in favor of that anyway? Or they'll just vote against it just to vote against it?
Oh, it's really hard to know. I think the Republicans are feeling betrayed by Manchin voting for the Inflation Reduction Act. So there is a little bit of a retaliation there with the lack of support. So we'll see. I think perhaps the most important thing about the runoff is that once it's done, we will have a much better idea of the legislative agenda until the end of the year. And that could be potentially market moving.
That's important, yeah. Yeah, one thing I want to ask you, I've been reading some stuff and heard from a few people that especially with the Russian invasion into Ukraine, that it's coming to light incredible issues that even the US has in their procurement process and in basically buying and establishing contracts, things in the FT, but also lunch I went to, now Ferguson was talking about it, that it's pretty dysfunctional, even in the US, how much red tape and stuff that you have to go through to order missiles. And also they need to kind of agree to, I guess, longer term contracts to really kind of commit real focus on building that kind of stuff. Is there any talk of that kind of, that would be bipartisan or?
So it would be wonderful if this could be fixed, because it's been a long-standing problem. Matt Stoller, who writes a lot about
you told me about him. Yeah,
he's great. I mean, I'm subscribed to his Substack, and I would encourage all our listeners to do the same. Yeah. He's written a lot about it, and the way the procurement system is structured in the US is terrible. We're really shooting ourselves in our own 2 feet, because we have a system that encourages suppliers to underbid so as to get the contract, and then lock us in for a very long time in weapons systems that are quickly becoming obsolete, because this is how they make their money through an upgrade of the system and the attached intellectual property. So this is a huge issue. We are spending we are spending on the military close to $1 trillion, and we are getting very little value because of this bad procurement system.
That's
and also because of the monopolies among defense contractors. So you have that, which is a long-standing issue. And then there is another issue which people are not talking about, but which in my view is fairly inflationary, which is the fact that weaponry systems in the West, and I guess in Russia as well, but we care much less about that, have been depleted. And
that's what made me even think,
we need to replenish them. And there are big issues with supply chains. And by the way, that this is even an issue shows you that the idea that our supply issues and bottleneck are behind us, this is just completely unrealistic.
Last question before we wrap up. I'm hearing like more talk of this, that the Fed could raise the 2% inflation target, even to 3%, just because the world's changed for the stuff that, not enough people are coming back into the market, the onshoring, the semiconductor issue, war, this kind, all this stuff. Is there any scenario where you see either explicit or implicit that the Fed is okay with, say, 3% inflation?
So that is going to be a big topic next year. I think the idea that they will do it in the short run is completely unrealistic, because you don't do that when inflation is like 3 or 4 times your target. You do it when inflation is under control.
Around.
So yeah. So I don't think it's an issue until we get to peak inflation. And I don't think we are anywhere near there. I think, the US needs to slow down much more. We need a big slowdown in wage growth. I mean, we are like miles apart from that point. But I think once inflation has peaked, there is an issue of how fast you go back to the 2%. I think the last time inflation was where it is was in 83, 84, and then it took more than 10 years to go to 2%. At the time, the Fed didn't have a 2% target. But I think once we reach a peak inflation, the speed of the disinflation is going to be an issue. And of course, the Fed could hide an implicit move to a 3% target.
That's what I'm saying. They could, yeah. So you're saying once it peaks, you don't think it's going to collapse. You think it'll be, or you do?
No, I really don't think so. And I think that's where the market is delusional as well, with the idea that there will be cuts next year. But again, I mean, I feel so out of step with conventional market thinking that, I mean, I don't know where to start. And
yeah,
I don't want
to. Well, I guess the wild card, to be fair, which is something you've been transparent about, interest rates have been so low for so long. They've been negative so much in Europe for so long. There's always the possibility of some mass, this Blackstone REIT,
sure.
they can't, like this, apparently there's technical reasons, other stuff. I'm talking to a friend in real estate, but there clearly could be gray swan, we'll have a hook towards ours, but like there's clearly breaking something, as we've talked about. And that could change things relatively overnight.
Completely. But there is an issue of sequencing here, which is we have inflation at 6 to 7%, likely to accelerate. The Fed cannot stop hiking because it is afraid of breaking something.
No, but I'm saying if they did break something. And by the way, we can all agree, like, something could break on Monday. We don't really see massive signs of that at this point, outside of obviously the crypto stuff. But there's always that possibility because there's embedded leverage everywhere. As you and Bilal particularly has done so much work on the collateral side. Yeah. That's the big risk, I guess, and no one can predict that at this point.
Yeah, but historically, if you look at the last two financial crises after the GFC and the tech bubble, the crisis happened after the Fed stopped hiking. So the Fed got inflation under control. Actually, there was no inflation before.
It wasn't like that. Yeah.
But it happened once the tightening cycle was concluded. So, and also in terms of sequencing again, the Fed is going to keep hiking as long as inflation is not under control. And I believe that in the end, they will probably overhike in the sense that they are going to trigger. I mean, it's impossible not to have some underlying weaknesses, and they'll end up triggering one. But I think it's quite in the future, frankly.
But have you changed your view? Can you see a pause? Obviously, no cutting, but like, can you see a pause if inflation's in the low 5s in March? In 3 or 4 months. So it feels like they're heading toward that point of. And then they may be wrong, and then inflation continues going higher, and they will have to hike, and maybe even aggressively again. But right now, do you see a continuation of 50-50-50, or do you think by March that they may pause and just see what the impact has been?
So they are not looking at 50-50-50. They are looking at where is inflation relative to our target. Is inflation giving signs that it's moving back to the target, or is it not? And my view as an economist is that it's going to keep going. So I wouldn't even exclude them going back to 75 if we have a really bad CPI month. I mean, I was looking at the oil shock. The peak PC inflation was 10%. So that's about 80 basis points. I'm talking core PC here. 80 basis point core CPI a month. If we get a month with 80, and we are not that far, because remember, we may well be at 50 basis point next month. So all we need is a little shock to the system.
That could come from anywhere. Yeah,
I think they would go back to 75.
Yeah, great debate as always. I always feel like everyone is so good. And it's great to hear from all our listeners that a lot of people kind of agree. And as we always say, please come back with feedback, any thoughts. You can even send us anything you guys want us. Maybe we'll have fun the next kind of 2 or 3 weeks before the end of the year. But before we go, maybe I'll just quickly go over some thoughts, some of the stuff that people haven't seen for our professional clients. Bilal did a really cool macroscope this week, I guess, which came out yesterday. What Buffett told me about trading stocks in an inflation era. That's certainly worth a really good read, and questioning the idea about equities as an inflation hedge. Kind of reopening, which kind of Bert and Caroline have kind of changed their view. And I would say been ahead of the curve for most of the year, in that there wouldn't be a reopening. Flip that view, and that it would be positive for China, positive for Asia FX, which to say have been two really strong calls. So a very interesting report. I think it also came out on Friday. Bilal did the rates weekly, where I think you guys kind of closed down which has obviously been a great trade, the 2s 10s inversion. Although I feel like you guys still I think this was just like a closing risk towards the end of the year, but generally you guys still pretty much believe in this trade.
Absolutely.
Yeah. And that's mainly because 2s will go up.
Yes.
But maybe even both, and 10s going down even from here.
Yeah.
So that's been cool. And then for Prime, and even free, I guess you read the beginning of it, but obviously we'd love for you to be able to read the whole arc on all the stuff that we produce. We started releasing a bunch of our gray swan. So some of the interesting ones, Disney buying TikTok. Ironically, I think Bilal didn't mention it. If I kind of remember that the first person that took over during Trump's presidency, when they were trying to separate out TikTok USA, is they brought a Disney executive in, and he was in for like 3 months. I'm pretty sure it was an ex-Disney. And I remember thinking, how much money could they possibly pay this guy to walk in front of a freight train? And lo and behold, they left after 3 months. But Disney buying TikTok. By the way, I think TikTok I thought it's still like $100 billion. Maybe he means Disney, TikTok US, I guess. But there's so much scrutiny, so it could be interesting. That probably would have to get real approval from authorities, and probably questions about their use of, I guess, the algorithms that they have to kind of manipulate viewership. And anyway, very cool one on private markets falling over, from Carl, and who knows private markets extremely well. We've had a few super interesting podcasts this year on private markets, and I think a lot of us believe that, and maybe this Blackstone news was just the beginning. But clearly there's been a huge amount of leverage in private markets, private credit, and all this stuff, that's safe because of no mark to market. And so that's an interesting one. And then I just was glancing at Torsten's thing about a very peculiar German coup. And I have to say, he is incredibly witty. So it looked super interesting. And if you haven't listened to, I just started listening to the David Rubenstein
podcast,
which is like, that's pretty serious, right? And what an amazing guy. So that's a super cool one. So I don't know, anything else you want to kind of add?
No, wait for our forthcoming gray swans. I have a couple of my own. This is always great fun to write. We try to really think out of the box. So, and it's short. So I hope people will read them.
Yeah. Well, and also quick reminders, we actually are having 2 webinars this week. For our pro clients, it's a webinar diving into a lot of the machine learning work we've been doing in general, but also with a big focus on FX carry and improving FX returns. And so that should be a really cool one with Bilal and Dalvir. And then another one just basically going through everyone's different gray swans, which should also be exciting. I think it's gray swans are Wednesday and machine learning is Thursday. We'll hopefully send out a recap of that as well, but it'd be great to see the videos ahead of time. And I think on the pro one, we should be giving people an opportunity to ask questions, I think, which would be really cool. So have a lovely weekend. Have a lovely weekend to everyone who's watching this, or week whenever you guys watch it. So, and happy holidays.
Good luck. I am hoping this is a week where we really get a break, and I think we all deserve it.
Great.
So thanks for listening.
Okay, thanks. Bye.
Bye.